Trading isn't gambling. It's a skill that can make you money if you learn the rules first. But where do you actually start? What's the difference between a smart trader and someone who loses everything in their first few months? In this audio summary, I'll walk you through the most important lessons from how to start trading, from understanding charts and risk management to building a strategy that really works. Ever opened a trading app, placed a few random trades, and wondered why your profits vanished? You're not alone. Every trader starts there. Stick with me till the end, and you'll know how to start trading the right way, confidently, safely, and with a plan that protects your money. Every great financial journey begins with a spark. Sometimes it's a friend who made a fortune trading stocks. Sometimes it's a headline about someone turning a few $1,000s into millions. And sometimes it's that quiet, restless feeling. The sense that there's a faster way to achieve financial freedom than just working a 9-to-5 job. That spark is where most traders are born, and it's as powerful as it is dangerous. Because while trading holds the promise of quick success, it also demands discipline, strategy, and the patience to master your emotions. Picture a young man named Ryan sitting in his apartment in Chicago, scrolling through social media late at night. His feed is filled with clips of traders surrounded by glowing monitors, flashing charts, and captions that read, "I made $2,000 before breakfast." Ryan's heart races. He opens a trading app, creates an account, and deposits his first $500. In that moment, he's not just clicking buttons. He's stepping into one of the oldest, most intense psychological arenas in human history. He's about to learn what every trader learns sooner or later, that markets aren't just numbers. They're reflections of human emotion, fear, greed, and hope, compressed into prices that change every second. Trading appeals to something primal in us: the desire to win, to outsmart others, to control our destiny. The idea that you can make money from your phone, from anywhere in the world, feels liberating, and it is, but only when you learn how the game truly works. For many, that first spark quickly turns into an obsession. They spend nights learning about candlesticks, moving averages, support, and resistance. They feel alive. But trading isn't a lottery ticket, it's a craft. The market rewards patience and punishes impulsiveness. The truth is, most traders don't fail because they lack intelligence. They fail because they lack control. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." It's a simple truth that every beginner must face. The market doesn't owe you money. It doesn't care about your predictions. It responds to preparation, discipline, and experience. Nothing else. But here's the good news. Anyone can learn it. Trading is not about genius. It's about growth. The people who succeed are not those who are always right, but those who learn from being wrong without giving up. They understand that every loss is tuition paid for experience, and every win is a test of humility. When you start trading, you are, in a way, stepping into a mirror. You'll see your own fears and impulses reflected back at you. Greed when prices rise, fear when they fall, overconfidence after a win, hesitation after a loss. The greatest traders are not those who master the market. They're the ones who master themselves. Ryan, like many beginners, made all the classic mistakes. He chased stocks that were already soaring. He panicked and sold too early. He watched his balance swing wildly and realized that trading wasn't just about charts. It was about psychology. But something inside him shifted. Instead of quitting, he decided to learn. He started reading, observing, studying how professionals think. And slowly, he began to understand that trading was never about beating the market. It was about aligning himself with it. Trading is one of the few pursuits in the world where your biggest opponent is invisible. And it's you, the voice that says, just one more trade. The fear that says, you'll miss out. The impatience that whispers, you should have doubled your money by now. Learning to silence that noise is what separates amateurs from professionals. So if you've ever felt the thrill of watching a stock price move and thought, I could do this, you're already part of a long tradition, one filled with risk, discovery, and opportunity. But before you can profit from the market, you must understand the world you're stepping into. You must learn its rules, its rhythms, and its traps. In the chapters ahead, we'll dive deep into how trading really works, from understanding market psychology to building a strategy that fits your personality. You'll learn how traders make decisions, how they manage risk, and how they build consistency in a world that seems chaotic. The spark you feel right now, that curiosity, that excitement, is your entry ticket. But what you do with it will determine whether you become another statistic or a skilled trader who thrives through knowledge and patience. In the next chapter, we'll step into the real foundation of trading, understanding the market itself. Because before you can trade successfully, you must first learn what you're truly trading against. Before you place your first trade, before you even look at a chart, you need to understand what the market actually is. Most people think of it as a machine that prints money for those who know the right tricks. But the market is not a machine. It's a living ecosystem, pulsing with emotion, psychology, and patterns. It's a global stage where millions of traders and investors act out their beliefs, fears, and predictions every second. Imagine standing in the middle of Wall Street during trading hours. Giant screens flash red and green numbers. Brokers shout orders. Analysts whisper into headsets, and the air vibrates with urgency. What you're really witnessing is not chaos. It's collective human behavior. Each price tick is a vote of confidence or doubt, a ripple created by billions of dollars reacting to news, rumors, and emotion. The stock market, or any market for that matter, whether it's forex, crypto, or commodities, exists for one reason: to connect buyers and sellers. Every time you trade, you're buying someone's story and selling your own. When you think a stock will go up, someone else thinks it won't. And that disagreement, that tension, is what creates opportunity. The market thrives on opposing views. But here's the thing, it's not random. The market follows rhythms and cycles that have repeated for decades. Booms and busts, greed and fear, optimism and panic. They all move in waves. History doesn't repeat perfectly, but it rhymes enough for those who listen carefully to profit from it. Think of the 2008 financial crisis, the 2020 pandemic crash, or the dot-com bubble of the early 2000s. Each of these events felt unique in the moment, but at their core, they were fueled by the same human emotions: overconfidence, denial, fear, and finally acceptance. When you trade, you're not just dealing with numbers, you're dealing with crowd psychology. Every chart pattern you see is a snapshot of human emotion. A sudden spike in price often signals excitement or greed. A sharp drop shows panic or despair. The best traders don't fight the market's emotions, they read them like a language. They understand that behind every chart there are people reacting, hoping, fearing, and second-guessing. To truly grasp how the market moves, you must also understand its participants. There are the institutional giants, hedge funds, mutual funds, and big banks, moving billions with a single click. And then there are retail traders, individuals like you, who form the heartbeat of modern trading platforms. Institutional traders rely on research, algorithms, and data. Retail traders rely on intuition, strategy, and courage. Both matter and both shape how prices move. Take the story of Jake, a college student who started trading small-cap stocks. In his first few weeks, he noticed that certain stocks surged right after news headlines appeared on social media. He thought he was discovering hidden gems. But what he didn't realize was that by the time he reacted, the institutions had already acted. By the time the news reached him, algorithms had bought and sold in milliseconds. That was Jake's first real lesson. Markets move faster than feelings. He learned to look beyond the noise and study the deeper patterns: volume changes, price structure, and institutional footprints. Understanding the market also means understanding yourself in relation to it. You can't control what prices do. You can only control your response. Many beginners lose money not because the market is against them, but because they're trading emotions instead of systems. They buy out of excitement and sell out of fear. To trade successfully, you must do the opposite. Buy when fear is high, sell when greed dominates. It's not easy, but it's the mindset that separates professionals from amateurs. Here's something profound to remember. The market doesn't have a memory. It doesn't care what price you bought at or how much you hope to make. It simply reflects the collective psychology of its participants in real time. If you can understand that, if you can see the crowd but remain detached from it, you've already taken your first step toward mastery. So as we move forward, let's redefine what trading means. It's not gambling. It's not luck. It's the art of managing risk, reading patterns, and understanding behavior, yours and everyone else's. The market rewards those who learn its rhythm and punishes those who chase its noise. In the next chapter, we'll dig into something that every successful trader treats as sacred: risk management. Because before you focus on making money, you must learn the single most important rule in trading: how not to lose it. Before you ever think about profits, you must think about protection. Trading isn't about making money fast. It's about staying in the game long enough to make money consistently. And the only way to do that is by mastering risk management. This is the invisible armor that separates the amateurs who blow up their accounts from the professionals who thrive for decades. Let's start with a simple truth. Every trade is uncertain. You might analyze a chart for hours, read the latest reports, and feel completely confident and still lose money. That's not failure. That's the nature of trading. The goal isn't to avoid losing. It's to make sure that when you lose small, and when you win big. Risk management is about controlling the size of your losses, so no single trade can destroy your progress. Imagine this. You have $10,000 in your trading account. You find a great opportunity, feel excited, and decide to put $5,000 into one trade. If it goes wrong, and it easily could, you've lost half your capital. That's a hole it's hard to climb out of, emotionally and financially. But if you had risked only 1% of your account, or $100, the loss would barely sting. You'd be able to think clearly and plan your next move. That's a secret. Professional traders survive because they never bet the house. The first principle of risk management is the 1% rule. Never risk more than 1% of your total capital on a single trade. That means if your account is $10,000, your maximum loss should be $100 per trade. It might sound small, but over time, this discipline keeps you in the game. Small losses are part of the process. Large losses are what end the journey. But risk management isn't just about position size. It's also about knowing when to exit. Many traders focus so much on finding the perfect entry that they forget to plan the exit. You must always know where you'll get out, both if you're right and if you're wrong. That's where stop-loss orders come in. A stop-loss is a preset point where you automatically exit a trade to limit your loss. It protects you from emotional decisions, sudden reversals, and the temptation to just hold a little longer. Think of a stop-loss as your parachute. You hope you'll never need it, but you always have it ready. No professional jumps out of a plane without one. And no professional trader enters a position without a stop-loss. Now let's talk about another key aspect of risk management: reward-to-risk ratio. This is how you determine whether a trade is worth taking. For example, if you risk $100 on a trade, you should aim to make at least $200 or $300 if it succeeds. That's a 2-to-1 or 3-to-1 reward-to-risk ratio. Why does this matter? Because even if you're right only 40% of the time, you can still be profitable if your winners are larger than your losers. Trading isn't about being right. It's about managing outcomes. There's also the mental side of risk management, and this might be even more important. The moment you risk more money than you're comfortable losing, your emotions take over. You start watching every price tick, panicking at small drops, and ignoring your plan. Trading turns into gambling. The best traders are calm because their risk per trade is small enough that even a loss doesn't shake their confidence. They live to trade another day. Consider the story of Maya, a trader who started small but grew her account steadily over 5 years. Her secret? She treated every dollar as a soldier. Her goal wasn't to send all her soldiers into one battle. It was to keep her army strong enough to fight tomorrow. When she lost gracefully. When she won, she added to her army. Today she trades full-time, not because she never lost, but because she never lost big. Another mistake beginners make is overtrading, taking too many trades at once. It spreads your focus thin and increases your exposure to market volatility. Every trade should have a clear purpose and a reason. Patience is a form of risk management. Sometimes the best trade you can make is no trade at all. Here's the mindset shift you must make. Your first job as a trader is not to make money. It's to protect your capital. Once you master that, profits follow naturally. You can't control what the market gives, but you can control what it takes away. Risk management isn't just a strategy, it's your survival kit. It's the reason professional traders can face losing streaks and still stay confident. It's why they view trading as a marathon, not a sprint. In the next chapter, we'll move deeper into the foundation of every great trader's toolkit: technical analysis. You'll learn how to read charts, identify trends, and use patterns to spot high-probability trades. Because once your capital is protected, it's time to learn how to grow it intelligently. If risk management is your armor, then technical analysis is your map. It's the visual language of the market, a way to interpret what traders are thinking, feeling, and doing without ever meeting them. Every price movement tells a story. Every chart holds clues. And if you can learn to read those clues, You can begin to predict where the market might go next, not with certainty, but with probability. That's what great traders do. They don't guess, they calculate. Picture this. You're watching the stock chart of Apple on your screen. Prices rise, pause, fall a little, then shoot up again. To the untrained eye, it's random. But to a trader who understands technical analysis, it's a living pulse. Buyers and sellers negotiating in real time. Each candle, each bar, and each line represents human behavior. Greed, fear, confidence, hesitation. Technical analysis turns that chaos into something you can read, measure, and use to make informed decisions. At its heart, technical analysis is based on one timeless principle. Price reflects everything: news, earnings, rumors, political tension, investor psychology. All of it gets absorbed into the price. That's why traders don't need to know why the market is moving. They just need to know that it's moving and where it might go next. As legendary trader John Murphy once said, "Charts don't predict the future, but they show you where the probabilities lie." Let's start with the building blocks. Trends. A trend is simply the direction in which prices are moving over time. When prices make higher highs and higher lows, that's an uptrend. When they make lower highs and lower lows, that's a downtrend. And when prices move sideways in a tight range, that's a consolidation phase. Successful traders learn to identify these trends early and trade with them, not against them. There's a famous saying, "The trend is your friend until it ends." It's a cliche for a reason. Imagine surfing on a wave. You don't fight the ocean, you ride with its motion. Trading is the same. You don't fight market momentum, you flow with it. Trying to go against the trend is like swimming upstream, exhausting and dangerous. Next, let's talk about support and resistance, the invisible walls that guide prices. Support is a price level where buyers step in to stop the market from falling. Resistance is where sellers appear to stop prices from rising. These levels form because of human memory. If a stock bounced from $100 before, traders remember that. And when it approaches $100 again, they expect it to bounce once more. These patterns repeat because human psychology doesn't change. Another powerful tool in your chart reading arsenal is the moving average. It smooths out price data and helps you see the broader trend without being distracted by short-term noise. For instance, a 50-day moving average can show you whether the medium-term trend is bullish or bearish. When the price is above the moving average, the market's momentum is generally upward. When it's below, caution is advised. Then there are chart patterns, recurring shapes that reveal the battle between buyers and sellers. Triangles, flags, head and shoulders formations. They all signal moments of potential change. For example, a breakout from a triangle pattern often indicates that a new strong move is beginning. These patterns work not because of magic, but because thousands of traders around the world recognize them and act on them, creating a self-fulfilling prophecy. But technical analysis isn't just about lines and patterns. It's also about emotion. Every spike in volume shows conviction. Every sharp reversal shows panic. When you study charts long enough, you begin to see the rhythm, the waves of excitement and fear that move the market like tides. Let's pause for a real-world example. Think back to March 2020, when global markets crashed due to the pandemic. Fear dominated. Then over time, as governments intervened and investors regained confidence, charts began showing higher lows, the first signs of recovery. Those who could read the chart saw the change before the headlines caught up. That's the edge of technical analysis. It lets you react faster than the news cycle. Now, a word of caution. Technical analysis is not a crystal ball. It doesn't guarantee outcomes. It simply helps you make better decisions based on probability. That's why great traders always combine it with solid risk management and emotional control. You might see a perfect setup, but if you over-leverage or panic at the first dip, even the best analysis won't save you. So how do you get better at this? By practice. Pull up charts every day, not to trade, but to observe. Watch how prices behave at support and resistance. Notice how trends form and break. Over time, your eyes will begin to see patterns instinctively. The same way a musician hears a wrong note instantly. Technical analysis is a lifelong skill. It's like learning to read a new language. At first confusing, then enlightening, and eventually second nature. Once you can read the market's language fluently, you stop reacting blindly and start anticipating intelligently. In the next chapter, we'll explore fundamental analysis, the art of understanding what lies beneath the numbers. You'll learn how to read financial statements, evaluate companies, and blend both technical and fundamental insights to make smarter, more balanced trading decisions. Because knowing why the market moves is just as powerful as knowing how it moves. While technical analysis tells you what the market is doing, fundamental analysis explains why. It's the difference between watching a movie and reading the script behind it. Both matter, but when you combine them, your understanding deepens dramatically. Fundamental analysis helps you see the true value behind a company, the story, the numbers, and the potential that shape its price movements. Picture this. You're looking at two companies. One has flashy stock movements and constant media buzz, while the other quietly grows its earnings every quarter. Most traders chase the first one because it feels exciting, but the real money often hides in the second. That's the magic of fundamental analysis. It allows you to separate hype from reality, speculation from substance. So what exactly is fundamental analysis? It's the process of evaluating a company's financial health, management quality, industry position, and growth potential to determine whether its stock is underpriced or overvalued. It's like being a detective, searching through clues hidden in balance sheets, income statements, and market trends to uncover the truth. Let's start with the foundation, the financial statements. These are the X-rays of a company's health. The balance sheet shows what the company owns, assets, what it owes, liabilities, and what's left for shareholders, equity. The income statement reveals how much the company earns and spends over a period, giving you a sense of profitability. And the cash flow statement shows where the real money is moving, often exposing strengths or weaknesses that profits alone can't show. Here's a simple rule. Cash flow never lies. Companies can manipulate earnings with accounting tricks, but cash flow tells the real story. If a company generates consistent positive cash flow from operations, it's often a sign of strength and resilience. Now, numbers alone aren't enough. You must understand the business model, how the company actually makes money. Does it rely on a single product or have a diverse range of offerings? Is it dependent on one market or does it operate globally? Is it innovative or is it simply surviving on past success? The best investors always look beyond the quarterly reports to understand how the company fits into the larger picture. Take Apple, for example. When Steve Jobs introduced the iPhone, It wasn't just a new product. It was the beginning of an entire ecosystem that would lock users into Apple's world. The company's financials reflected that vision years later, as recurring revenues from services like iCloud and the App Store began to dominate. That's what great investors spot early, a story that makes the numbers make sense. Another crucial part of fundamental analysis is valuation, figuring out what a company is truly worth. You might have heard of metrics like the price to earnings, P/E ratio, which compares a company's stock price to its earnings per share. A lower P/E might indicate a bargain, while a higher one could signal that investors are paying for future growth. But remember, context matters. A tech company with a PE of 40 might still be cheap if it's growing earnings by 50% annually, while a slow-moving utility company might be expensive even at a PE of 15. There are also ratios like price to book, P/B, debt to equity, and return on equity, ROE, each offering insights into how efficiently a company uses its capital and how financially stable it is. But don't get lost in the math. The real purpose of these numbers is to help you answer one key question. Is this company worth owning at this price? Fundamental analysis also involves looking at the bigger picture, the economy, interest rates, and market trends. For instance, when interest rates rise, borrowing becomes more expensive, which can slow down corporate profits. When consumer spending increases, retail and tech companies often benefit. Great investors don't just analyze companies. They analyze the world those companies live in. And of course, we can't forget the role of management. A company's leadership can make or break its future. Warren Buffett, one of the most successful investors of all time, often says he invests in people as much as in businesses. A strong CEO with a clear vision, integrity, and a track record of execution can turn an average company into a great one. Let's use a real-world example. In 2013, Netflix was struggling. Its stock had fallen, competitors were rising, and many analysts predicted its downfall. But CEO Reed Hastings doubled down on original content, betting that streaming would reshape entertainment. That decision, grounded in long-term vision, made Netflix one of the most successful companies of the decade. Those who looked beyond short-term losses and believed in the fundamentals earned massive returns. The beauty of fundamental analysis is that it helps you think like an owner, not a trader. You stop chasing short-term noise and start focusing on long-term value. You ask smarter questions. Is this company growing sustainably? Does it have a moat, a competitive edge that protects it from rivals? Is its leadership aligned with shareholders? When you combine this mindset with technical analysis, you get the best of both worlds. Timing and conviction. You know when to buy, and you know why you're buying. That's a powerful combination that can turn an ordinary investor into a strategic trader. In the next chapter, we'll move from theory to action, learning how to build your first trading strategy. You'll see how to combine the principles of analysis, risk control, and psychology into a plan you can actually use. Because success in trading doesn't come from random moves, but from consistent, well-thought-out systems that guide every decision you make. So far, you've learned the language of charts through technical analysis, uncovered the story behind stocks through fundamentals, and mastered the discipline of risk management. But now comes the most exciting, and often the most misunderstood, part of your trading journey: building your very own trading strategy. This is where knowledge turns into execution, where you move from reacting to the market to acting with purpose. A trading strategy isn't a secret formula that guarantees riches overnight. It's a set of rules that guide your decisions: when to enter a trade, when to exit, and how much to risk. It removes emotion from the process, replacing impulse with structure. Think of it as your personal playbook, one that evolves with experience but always keeps you grounded in logic. Let's begin by defining what a strategy really is. At its core, a trading strategy combines a market edge, a set of entry and exit rules, and a money management plan. Your edge is what gives you a slightly higher probability of success compared to randomness. It could be as simple as trading with the trend, using moving averages, or identifying breakouts after consolidation. The key is consistency, repeating what works over time instead of jumping from one idea to the next. Imagine you decide to trade based on the 50-day and 200-day moving averages, a classic trend-following approach. Your rule might be, buy when the 50-day crosses above the 200-day, a golden cross, and sell when it crosses below, a death cross. That's your entry and exit rule. It's simple but powerful because it allows you to follow momentum rather than emotion. Now suppose you add another layer, confirmation from trading volume. You only act on a crossover if volume spikes above average, signaling strong conviction. That's refinement, and that's how strategies mature, by layering logic, not luck. But a strategy isn't just about the technicals. It's also about time frames. Are you a day trader who closes positions before sunset? Or a swing trader who holds for a few days? Or a position trader who rides long-term trends? Each time frame has its own rhythm, risks, and rewards. Trying to mix them usually leads to confusion. A trader who uses long-term strategies but checks their account every hour will burn out fast. Pick a time frame that fits your personality and lifestyle, not someone else's success story. Here's something most beginners overlook: testing your strategy before risking real money. This process is called backtesting. It means applying your rules to historical data to see how they would have performed. You're not looking for perfection, you're looking for consistency. Even great strategies have losing streaks. The goal is to ensure your system has a positive edge over many trades. Let's take an example. You design a breakout strategy that buys when a stock breaks above a key resistance level and sells when it hits a certain profit target or stop loss. You test it on 5 years of historical data and find it wins 55% of the time, but yields an average profit twice the size of its average loss. That's a good sign. A professional trader knows that a small edge, applied consistently with discipline, compounds into big results over time. A crucial element of every strategy is position sizing. How much to trade each time? Even with a great system, poor sizing can destroy your account. That's why professional traders risk only 1 to 2% of their capital on each trade. It might sound small, but it allows you to survive bad streaks and capitalize on good ones. Think of your capital like fuel for a rocket. You can't afford to burn it all on one launch. Another mistake new traders make is constantly changing strategies. After 2 or 3 losing trades, they abandon one method and jump to another. This is called strategy hopping, and it's the fastest way to stay stuck in mediocrity. Every system has ups and downs. The key is to understand your edge and give it time to play out. Discipline beats brilliance in the long run. It's also important to document your trades, to keep a trading journal. Record every trade you take, why you entered, how you felt, what happened, and what you learned over time. This becomes your personal data set, revealing patterns in your behavior. You'll discover your strengths, your weaknesses, and the habits that hold you back. The best traders in the world are also the best record keepers. They know that success in trading is not about prediction, it's about process improvement. Let's bring in a real-world story. Consider Alex, a retail trader who spent 2 years losing money because he had no system. Every trade was emotional, driven by headlines, tweets, or gut feelings. One day he decided to treat trading like a business. He studied price patterns, back-tested his ideas, and built a strategy around trend following and strict stop-loss rules. 6 months later, he wasn't rich, but he was consistent, and that's when real growth began. His goal shifted from making money to executing flawlessly. Money followed naturally. Here's a golden rule. Simplicity scales. The most profitable strategies are usually simple but executed with extreme discipline. You don't need 10 indicators on your chart or a complex algorithm. You need a few clear signals and the patience to follow them. Every successful trader you admire, from Paul Tudor Jones to Linda Raschke, built systems that are structured, repeatable, and emotionally neutral. Now that you understand how to build your first strategy, it's time to explore what makes it truly work. Your mindset. Because even the best system can fail in the hands of someone who can't control their emotions. In the next chapter, we'll dive deep into trading psychology, how fear, greed, and confidence shape your decisions, and how mastering your mind can make you a far better trader than mastering any chart pattern ever could. Every trader dreams of mastering the market, but the truth is, the greatest battle isn't out there on the charts. It's inside your own mind. Trading psychology is the invisible force that determines whether your knowledge becomes wealth or wasted potential. You can have the perfect strategy, flawless analysis, and cutting-edge tools. But if your emotions take control when money's on the line, your trading journey will always feel like a roller coaster. Let's start with an uncomfortable truth. The market doesn't care about you. It doesn't care about your goals, your plans, or how badly you need a win. It moves according to billions of decisions made by millions of participants, all driven by fear and greed. The only thing you can truly control is your reaction to it. That's where trading psychology begins, in mastering yourself before you try to master the market. Think back to a time when you made an impulsive decision. Maybe you chased a trade after missing a move, or doubled down on a losing position to get your money back. Those moments weren't about logic, they were about emotion. Fear of missing out, FOMO, and fear of loss, FOLO, are the twin enemies of every trader. They whisper lies that feel like urgency. Everyone else is making money, you're missing out. Or, if you just hold a little longer, it'll bounce back. These are emotional traps that empty trading accounts faster than bad strategies ever could. The key to overcoming them is building emotional awareness. Start by recognizing your triggers. Maybe it's watching a stock move without you, or seeing red numbers in your account. The moment you feel emotion rising, step back, take a breath. Remind yourself, your goal isn't to win today, it's to trade well every day. Trading is a long game, and emotions are short-term thinkers. Professional traders treat their minds like athletes treat their bodies, with discipline, rest, and constant training. They follow routines, not impulses. They meditate, journal, and sometimes even step away from the screen for days to regain perspective. Because they know something most people don't. You don't make money in the trade. You make it because of your mental preparation before the trade. Let's talk about two of the most destructive emotions in trading: fear and greed. Fear is what makes you close winning trades too early, afraid the market will take your profits. It's what freezes you when prices fall, turning a small loss into a catastrophic one. But fear isn't the enemy, it's information. It tells you where you're overexposed or underprepared. The trick is to use fear as a signal, not as a guide. When you feel it, don't react. Review. Ask yourself, is this fear logical or emotional? Logical fear keeps you cautious. Emotional fear keeps you paralyzed. Greed, on the other hand, is what convinces you that this one trade will change your life. It makes you increase your position size, ignore your stop loss, and stay in a trade long after the signs of reversal appear. Greed gives you hope, but hope isn't a strategy. The market rewards discipline, not desperation. The moment you start trading because you need to make money, you've already lost control of your process. Now there's another emotion that doesn't get enough attention: overconfidence. It sneaks in quietly after a streak of wins. You start believing you've cracked the code, that the market owes you. This is when traders take unnecessary risks and give back months of profits in a single bad week. The cure? Humility. The best traders in the world constantly remind themselves that they can be wrong at any time. They respect the market's power more than their own predictions. One of the most powerful tools in mastering trading psychology is detachment. You must learn to see each trade as just one of 1,000, not a make or break event. Imagine a casino that has millions of dollars at stake every day. Do you think the casino owner panics when someone wins a jackpot? Of course not. They know that over time, their edge will make them profitable. That's how you should view your trading system, as a business with probabilities, not emotions. Let's look at a real-world example. Mark Douglas, in his legendary book, Trading in the Zone, wrote that consistent traders think in terms of probabilities, not certainties. They accept that losses are part of the process, just like costs are part of running any business. Once you stop fighting losses and start managing them, trading becomes far less stressful and far more profitable. A practical exercise for mastering your mind is the pre-trade checklist. Before every trade, ask yourself, am I following my plan? Is this setup aligned with my strategy? What's my risk? What will I do if the trade goes wrong? These questions anchor you in logic and reduce impulsive decisions. And when things go wrong, because they will, don't spiral. Take a break, review your journal, and treat each mistake as a teacher. Every professional trader has gone through massive losses at some point. The difference is that they learn from them instead of running from them. The market is the most brutal but honest mentor you'll ever have. Here's the truth: mastering psychology doesn't make trading easy, it makes it manageable. You'll still feel fear, greed, and frustration, but they won't control you anymore. You'll act according to your system, not your impulses. That's when trading becomes not a gamble, but a craft. In the next chapter, we'll move from the internal to the external, exploring market analysis and trends. You'll learn how global events, economic cycles, and sector shifts shape the markets you trade, and how to align your strategies with the bigger picture instead of fighting against it. Because true mastery isn't about predicting the market, it's about moving in rhythm with it. If trading psychology is the mind of a trader, market analysis is the world that mind must navigate. Every chart, every price, every candle you see on the screen is part of a vast interconnected ecosystem driven by global events, economic forces, and collective human behavior. To trade successfully, you must learn to move with the market, not against it. This is the art of understanding market trends and aligning your strategies with them. Let's begin with the foundation. Markets move in cycles. These cycles repeat because human nature doesn't change. Greed pushes prices up, fear pulls them down, and hope brings them back again. If you zoom out on any long-term chart, be it stocks, forex, or commodities, you'll see the same pattern. Uptrends, corrections, consolidations, and downtrends. These aren't random. They're reflections of how people collectively feel about the economy and risk. There are three major types of market trends: uptrend, downtrend, and sideways trend. An uptrend is defined by higher highs and higher lows, a sign that buyers are in control. A downtrend, the opposite, shows lower highs and lower lows, meaning sellers dominate. And a sideways trend occurs when prices fluctuate within a tight range, with neither buyers nor sellers taking charge. Recognizing these patterns early gives you a powerful advantage. You can choose to trade in harmony with the direction of momentum rather than against it. Imagine trying to swim across a river. You can either go with the current or fight against it. One option exhausts you, the other carries you forward. Trading works the same way. Those who learn to identify the current, the trend, often find themselves riding profitable waves, while those who trade against it are left drained and frustrated. To identify trends, traders use tools like moving averages, trend lines, and indicators such as the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD. But beyond these tools, what truly matters is context. The same chart can look bullish on a daily time frame and bearish on a monthly one. That's why professional traders always zoom out before zooming in. They want to understand the bigger picture before deciding on their next move. For example, let's take the S&P 500. Suppose you're analyzing it in early 2020. The daily chart shows a sharp sell-off due to global uncertainty. Fear dominates. But when you step back to the weekly chart, you realize that the long-term uptrend that started in 2009 remains intact. To a long-term investor, that sell-off might have been a buying opportunity. To a short-term trader, it was a chance to short the market for quick gains. Perspective defines opportunity. Understanding market phases is equally important. There are four classic stages: accumulation, uptrend or markup, distribution, and downtrend or markdown. During accumulation, smart money, institutional investors, start buying quietly after a period of decline. Prices stay flat and public interest is low. Then comes the uptrend, when optimism grows and the crowd joins in. Prices rise quickly as demand outpaces supply. Eventually, we reach distribution, where those same smart investors begin selling to the enthusiastic latecomers. Finally, the market enters the downtrend, as optimism fades into fear and prices collapse until value returns and accumulation begins again. If this sounds familiar, it's because you've seen it before. In every market boom and bust in history, from the dot-com bubble of the early 2000s to the crypto surge in 2021, the story is always the same. The characters change, but the emotions, greed, excitement, denial, panic, and despair never do. That's why legendary investor Jesse Livermore once said, The game does not change, and neither does human nature. Now, market analysis isn't just about charts. It's also about understanding the news that moves those charts. Economic data, central bank decisions, inflation reports, and geopolitical events can shift trends in seconds. For example, when the Federal Reserve hints at raising interest rates, stock markets often pull back because borrowing costs rise and liquidity tightens. Conversely, when rates drop, money floods into riskier assets, driving markets higher. But here's the twist. By the time the news hits the headlines, the market has usually already reacted. Smart traders don't chase the news, they anticipate it. They look at leading indicators like bond yields, employment data, and corporate earnings to get a sense of where sentiment is heading. They don't trade the news, they trade the reaction to the news. Let's ground this with a real-world scenario. In late 2022, inflation in the United States hit its highest level in decades. The Fed began raising interest rates aggressively. Stocks fell, and fear dominated the market. Yet by mid-2023, inflation started cooling, and investors began anticipating a slowdown in rate hikes. Those who read the signs early, the flattening yield curve, the stabilizing commodities, were able to position themselves for the next uptrend long before it became obvious. To become a market-savvy trader, you must blend technical and fundamental insights. Use technical tools to time your entries and exits, but let fundamentals guide your broader direction. If the economy is expanding, unemployment is low, and interest rates are stable, the overall market bias is likely upward. If corporate profits are falling and economic data weakens, prepare for defensive moves. Another concept worth mastering is sector rotation. How money flows from one part of the market to another as conditions change. When the economy grows, investors often favor tech, consumer discretionary, and financial stocks. When the economy slows, money tends to move into defensive sectors like healthcare, utilities, and consumer staples. Recognizing these shifts early allows you to ride the strongest waves while avoiding weak ones. In essence, market trends are not just about lines on a chart, they're about understanding collective behavior on a global scale. When you can read the rhythm of the market, you stop fighting it and start dancing with it. In the next chapter, we'll dive into the tools of modern trading, the platforms, software, and technologies that give today's traders unprecedented access and control. From algorithmic strategies to real-time analytics, you'll learn how to harness technology to trade smarter, faster, and more efficiently. Because in today's world, your tools can be just as powerful as your strategy. Trading today isn't what it used to be 20 years ago. Gone are the days when traders had to call brokers to place an order or watch ticker tapes roll across a screen. Today, technology has transformed trading into an instant, data-driven, and globally connected activity. With just a smartphone, anyone can access real-time charts, analyze global markets, and execute trades worth thousands of dollars within seconds. But technology, while powerful, is only as effective as the person using it. This chapter will help you understand how to use modern trading tools to gain a real edge. Not just to trade faster, but to trade smarter. Let's start with the foundation of all modern trading, the trading platform. Platforms like MetaTrader, TradingView, Thinkorswim, or Zero2Kite are where most traders live. They provide charting tools, indicators, news feeds, and execution systems all in one place. But not all platforms are equal. A professional trader chooses their platform based on stability, analytical features, and speed. A 1-second delay in execution can mean the difference between profit and loss, especially in fast-moving markets like forex or crypto. Beyond the platform lies the charting interface, your window into market psychology. Here you can visualize price action through candlestick charts, volume bars, and technical indicators. Candlesticks aren't just lines or boxes, they're stories. Each candle shows who's in control, buyers or sellers. Green candles reflect optimism, red ones represent fear. A cluster of long wicks might indicate indecision, while a strong bullish engulfing pattern could signal momentum. To a trained eye, charts reveal emotion, the collective push and pull of millions of decisions happening in real time. To analyze these movements, traders rely on technical indicators. Moving averages smooth out price data to reveal long-term trends. RSI, Relative Strength Index, helps identify when an asset is overbought or oversold. MACD, Moving Average Convergence Divergence, detects momentum shifts. Bollinger Bands highlight volatility. Yet here's the catch. Using too many indicators at once can confuse you. The best traders use a few, but use them well. They understand what each tool measures and why it matters in their specific strategy. Technology has also brought algorithmic trading into the mainstream. Algorithms, or bots, are computer programs that execute trades based on preset rules. These systems can scan thousands of stocks in seconds, searching for setups that fit a strategy, like a moving average crossover or a breakout pattern. They eliminate emotion, ensuring trades are executed with precision and discipline. But automation comes with a warning. If your algorithm isn't tested properly, it can make the same mistake over and over at lightning speed. The goal isn't to remove the human, it's to enhance the human. In the modern world, data is the new currency of trading. Successful traders don't just look at prices, they analyze sentiment, volume, and macroeconomic data. Tools like Bloomberg Terminal, Reuters, Icon, and even alternative data providers allow traders to see what's influencing markets beyond charts, like news headlines, social media trends, or global supply chain shifts. For example, an increase in Google searches for oil shortage might predict a rise in crude oil prices before traditional indicators catch up. Then comes AI and machine learning, which are reshaping trading like never before. AI-driven models can identify hidden correlations in data that human eyes might miss. They can process decades of market history in minutes and generate predictive insights about future movements. While these tools are complex and often reserved for institutional players, retail traders are slowly gaining access to simplified versions through AI-assisted platforms and predictive analytics tools. It's no longer just about what you see on a chart. It's about what the data knows beneath it. And of course, we can't talk about modern trading without mentioning mobile trading apps. Platforms like Robinhood, eToro, and Zerodha have democratized finance, allowing anyone from college students to retirees to start investing with a few taps. This accessibility is empowering, but it also creates new risks. Instant gratification, push notifications, and gamified interfaces can encourage overtrading. Technology can make trading feel like a game, but it's not. Real money is always on the line, and the easiest trades are often the most dangerous. Another game-changing advancement is social and copy trading. Platforms now allow you to follow top traders, observe their strategies, and even mirror their trades in real time. It's an incredible way to learn from professionals without having to reinvent the wheel. But again, caution is key. Blindly copying someone's trades without understanding their reasoning can backfire. Their risk tolerance, goals, and financial situation might be completely different from yours. Learn from others, but think for yourself. Modern traders also rely heavily on risk management tools integrated directly into platforms. Features like stop-loss orders, take-profit targets, and trailing stops automate discipline, protecting you from impulsive decisions. Some platforms even allow you to simulate trades using virtual money through paper trading. This feature is a blessing for beginners. It lets you test strategies without the fear of losing real money, while still experiencing the emotions of market movement. One of the most overlooked tools in trading isn't digital, it's your trading journal. Whether you use a simple spreadsheet or advanced journal software, recording your trades is essential. Note why you entered, where you exited, and how you felt during the trade. Over time, patterns will emerge. You'll see where you're strong and where emotion tends to cloud your judgment. The best traders treat their journal like a mirror, one that reflects their growth, weaknesses, and mindset. Let's not forget the power of education and community. Online forums, YouTube channels, podcasts, and trading courses have made learning accessible to everyone. You can now attend live webinars with professional traders or join Discord groups that discuss setups and strategies in real time. But as you explore, filter your sources carefully. The internet is full of self-proclaimed experts who flash profits but hide losses. Follow those who teach discipline, not hype. Technology is a double-edged sword. It gives you power, but also temptation. The same platform that allows you to study the market deeply also allows you to overtrade in seconds. The difference between success and failure lies in your ability to use these tools strategically, not emotionally. As the saying goes, a fool with a tool is still a fool. But a wise trader with the right tools? That's someone unstoppable. In the next chapter, we'll explore how to build your trading strategy. The personalized blueprint that combines psychology, analysis, and technology into a single effective system. Because tools alone don't make you profitable, how you use them does. By now, you've learned the fundamentals of markets, mastered risk management, and discovered the power of trading technology. But here's where everything comes together. Building your own trading strategy. Think of this as constructing your personal roadmap to consistency and freedom. Every great trader, from Paul Tudor Jones to Linda Raschke, follows a system that fits their personality, risk tolerance, and time commitment. No two traders are alike, and no single strategy works for everyone. This chapter will show you how to craft yours, the one that makes you confident, calm, and in control. Let's begin with a truth most beginners overlook. A strategy is not a set of rules. It's a reflection of how you see the market. Some traders love fast-paced environments like day trading, thriving on short-term momentum and adrenaline. Others prefer the calm rhythm of swing trading, holding positions for days or weeks. There are also position traders who build wealth slowly, letting trends unfold over months. Your first step is to decide who you are as a trader. Are you patient or impulsive? Do you enjoy studying charts for hours or prefer setting and forgetting? Your personality will shape your system more than any book or YouTube video ever will. Once you've identified your trading style, the next step is to choose your market focus. You can't trade everything. Pick one or two markets to specialize in. Maybe US stocks, forex pairs, commodities, or cryptocurrencies. Each market has its own rhythm, volatility, and reaction to news. By focusing, You start recognizing familiar patterns, just like a surfer learns the personality of waves at one beach. This familiarity gives you an edge. Now comes the foundation of your system, your setup. A setup is the condition you look for before entering a trade. It could be a moving average crossover, a breakout above resistance, a pullback in a trend, or even a volume spike. The key is to find situations where probabilities are in your favor. For example, you might decide to buy when the 50-day moving average crosses above the 200-day moving average, signaling a new uptrend. That's your green light. But don't just take trades based on one signal. Combine confirmations. Maybe volume must increase by 30% or the RSI must be above 50. The more filters you apply, the fewer trades you'll take, but the higher your success rate will likely be. Every good strategy also has a clear entry and exit plan. This means knowing when to buy, when to sell, and when to do nothing. The moment you enter a trade, you should already know where you'll exit if it goes wrong, your stop loss, and where you'll take profits if it goes right, your target. This pre-planning removes emotion. When you're in the heat of battle, emotions like greed and fear can cloud judgment. But a trader with a plan acts while others react. One of the most overlooked elements of a trading strategy is risk-reward ratio consistency. Professional traders don't chase every opportunity, they look for asymmetric setups, where the potential reward is at least twice or 3 times the risk. That's how they can afford to be wrong half the time and still make money. Think about that. A trader who loses 6 out of 10 trades but follows a 3-to-1 reward to risk plan still ends the month in profit. This is how you turn probabilities into power. Testing your strategy is where science meets experience. Start with backtesting, applying your rules to historical data to see how they would have performed. This helps you understand drawdowns, win rates, and potential returns before risking real money. Once you're confident, move to paper trading, using demo accounts to execute your system in live conditions. This lets you practice without emotional pressure. Finally, start small with real money. Even the best back-tested system can feel different in live markets. The real test isn't whether the strategy works, it's whether you can follow it. Here's the secret nobody tells you. Every trading strategy eventually stops working. Markets evolve, volatility shifts, and crowd behavior changes. The goal isn't to find a holy grail system, it's to become adaptable. Great traders constantly tweak and refine their approach while maintaining discipline in execution. That's why your trading journal is your most valuable companion. Record every trade, note what worked, what didn't, and how you felt. Over time, your journal becomes a personal textbook of experience, a mirror that reveals your growth and blind spots. Let's look at an example. Ethan, a part-time trader from Chicago, spent months developing a simple moving average strategy for tech stocks. It worked beautifully during trending markets, but failed when volatility increased. Instead of giving up, he modified it to include the average true range, ATR indicator, allowing him to adjust stop-loss distances based on market noise. The result? His losses decreased and his confidence grew. He didn't chase perfection, he built resilience. That's the essence of a real trader. Another pillar of your system is routine. Every professional trader has a daily routine that keeps them focused. For example, you might start your day by scanning the market for potential setups, reviewing economic calendars, and checking overnight news. Then during trading hours, you execute your plan. No distractions, no improvisation. After the session, You review performance, update your journal, and plan for tomorrow. Trading might look glamorous, but in reality, it's routine, repetition, and relentless discipline that generate results. And don't underestimate the mental framework behind your strategy. You could have the best setup in the world, but if you panic when prices fluctuate, it's useless. The mental strength to follow your plan, stay patient, and accept losses gracefully is what separates consistent traders from emotional ones. When you build your strategy, you're not just designing rules, you're training your mind to execute them with precision. Your trading strategy is your signature, unique, evolving, and deeply personal. It's the culmination of everything you've learned: risk management, analysis, psychology, and patience. With it, you gain not just a plan to make money, but a structure to grow discipline, self-awareness, and financial independence. As we approach the next chapter, we'll explore the ultimate goal that every trader dreams of: achieving financial freedom through consistency. You'll learn how to scale your profits, compound your earnings, and build a life where your money works harder than you do. Because trading isn't just about mastering the market, it's about mastering yourself. Every trader dreams of consistent profits. The idea that you could wake up each day, follow your plan, and steadily grow your capital sounds almost magical. But the truth is, consistency isn't about magic, it's about method. It's about mastering the habits, routines, and mental frameworks that allow you to perform with discipline, even when the markets test every ounce of your patience and emotional control. In this chapter, we'll explore how to transform trading from a series of lucky wins into a lifetime craft that generates steady success. Consistency begins with understanding probabilities. Every trade you make has an uncertain outcome, but over a large number of trades, patterns emerge. Think of trading like flipping a weighted coin, one that lands on win 55% of the time and lose 45% of the time. If you manage your risk correctly and stick to your system, those odds compound in your favor over time. Yet most beginners sabotage themselves by changing strategies after just a few losses, never allowing probabilities to work for them. Professionals know that it's not about any single trade. It's about the next 100 trades. Consistency also means embracing boredom. That might sound strange, but the best traders find peace in repetition. They analyze charts the same way, enter trades the same way, and log results the same way. The excitement that most beginners chase, the adrenaline rush of big wins, is exactly what destroys discipline. True consistency comes when trading feels calm, even uneventful. You don't need fireworks, you need flow. Let's take the example of Alex, a trader who started with $2,000 and lost it twice before finding success. The turning point wasn't a new strategy, it was a new mindset. He decided to stop chasing every opportunity and instead focus on executing just one setup. He understood deeply: breakouts with volume confirmation. He traded that single pattern for a full year. His win rate didn't skyrocket, but his equity curve began to rise steadily. Small wins, smaller losses. That's the rhythm of consistency. To stay consistent, you need a structured trading plan, one that outlines your setups, risk parameters, trading hours, and review process. This plan isn't just for discipline, it's your anchor during chaos. When markets swing wildly or emotions run high, your plan tells you exactly what to do, and just as importantly, what not to do. You stop making impulsive decisions because your system already defines how you respond. The next pillar of consistency is risk-adjusted thinking. Professional traders measure performance not by how much they make, but by how much risk they take to make it. For example, earning $500 by risking $100 is far better than earning $1,000 by risking $2,000. Consistent traders don't swing for the fences. They look for controlled opportunities with defined risks. Over time, they understand that the power of compounding doesn't come from big wins. It comes from avoiding big losses. Then there's the emotional aspect, the hardest part of all. Trading consistency requires emotional consistency. The market doesn't owe you anything, and some days even the best setups fail. The ability to accept a loss calmly without revenge trading or frustration is what keeps your long-term curve rising. Meditation, exercise, journaling, or even stepping away for a walk. All of these habits help reset your mental state. Remember, you can't control the market, but you can control your response to it. Consistency also depends on tracking and adapting. The best traders treat their journals like laboratories. Every week, they review what worked, what didn't, and why. Maybe their strategy performs better during specific hours or in certain market conditions. By analyzing results, they fine-tune their edge. This constant iteration is how amateurs evolve into professionals. As Paul Tudor Jones famously said, the secret to being successful from a trading perspective is to have an indefatigable and an undying and unquenchable thirst for information and knowledge. But let's address a truth most trading gurus skip over. Even the most consistent traders face drawdowns. Periods when the market doesn't align with their system, when confidence dips, when results stall. These phases test your resolve. Consistent traders survive because they manage expectations. They don't panic, they don't abandon their process, and they don't double their position sizes to make it back. They trust their edge, knowing that just as losing streaks come, winning streaks will too. Another key factor is balance. It's easy to let trading consume your entire life, staring at charts, checking prices on your phone, losing sleep. But burnout kills consistency. The most sustainable traders structure their day. They trade during set hours, review afterward, and then disconnect completely. They treat trading as a business, not an obsession. That balance allows for longevity. Remember, your goal isn't just to win today, it's to still be trading 10 years from now, with skill, calm, and confidence. Technology can also support your consistency. Automated alerts, backtesting tools, and journaling software can take emotion out of your routine. You can set rules to remind you when to enter, when to exit, and when to step away. But never outsource your judgment completely. Automation supports discipline, but you are still the pilot. Let's imagine your trading journey as a staircase. Every step represents a new level of mastery, from learning charts to handling losses, from understanding risk to maintaining discipline. The climb is slow, steady, sometimes tiring, but with every step, your confidence grows. You begin to see trading not as a gamble, but as a craft, something you can improve for a lifetime. And that's the final piece of consistency: gratitude and perspective. Appreciate the process. Celebrate progress, not perfection. Every mistake teaches you something. Every win reinforces your patience. When you start viewing trading as a long-term skill, rather than a short-term money grab, your mindset shifts. You start thinking like an investor in your own growth. In the final chapter, we'll bring everything full circle, From learning the basics to achieving true trading independence. We'll talk about scaling your success, managing larger capital, and building the kind of financial freedom that allows you to live life on your own terms. Because once you achieve consistency, the next step is creating wealth that lasts a lifetime. You've made it this far. Through the highs and lows, the psychology, the strategies, and the discipline that separates dreamers from doers. But now comes the most exciting chapter of all, learning how to scale your success. It's one thing to trade well. It's another to turn that skill into lasting wealth and freedom. This final chapter is about transforming trading from a part-time pursuit or passion into a true pathway toward financial independence. Let's start with a powerful idea. Scaling doesn't mean trading more. It means trading smarter. Many new traders think the way to make more money is to increase the number of trades or take on bigger risks. But professionals know that scaling is a gradual, methodical process. You earn the right to trade larger by proving you can manage smaller positions consistently. Think of it like building muscle. You don't lift 200 pounds on day one. You start small, focus on form, and gradually increase weight as your strength grows. Trading is no different. The first step to scaling is compounding. Compounding is the silent engine of wealth. The process of reinvesting profits to generate even greater returns. Let's say you start with $5,000 and earn just 5% a month. That might not sound like much, but after 1 year, your account grows to over $9,000. After 2 years, over $16,000. Compounding is exponential, not linear. The key is to protect your base, grow steadily, and let time and discipline do the heavy lifting. However, before you scale, you must ensure your system is robust. That means it performs well under different market conditions, trending, volatile, or range-bound. Test it using multiple assets, time frames, and risk levels. Only when you've proven your edge across these environments should you begin increasing your position sizes. For example, if you normally risk 1% of your account per trade, you can move to 1.5% after 6 months of consistent results, then 2%. Small, steady increases are sustainable. Sudden leaps are dangerous. One of the biggest traps traders fall into during scaling is overconfidence. After a few successful months, it's easy to feel invincible. But markets are humbling teachers. Just when you think you've mastered them, they shift. That's why humility is your most valuable asset. Treat every trade as if it's your first. Respect your plan. Respect your risk. Professional traders are confident, yes, but they're never complacent. Next, we need to talk about diversification. When you first start trading, it's smart to focus on one market, say stocks or forex, so you can master its rhythm. But as you grow, diversification helps stabilize your income. You can explore multiple asset classes, equities, commodities, cryptocurrencies, or index funds. This reduces dependency on one type of market condition. For instance, when stock markets are quiet, commodities or currencies might be trending. Diversification gives you flexibility, the ability to profit in any environment. Scaling also means thinking beyond the charts. Many traders eventually expand their skill set into other forms of investing, long-term portfolio management, real estate, or even building businesses. Trading sharpens your decision-making, patience, and risk assessment, all traits that translate beautifully into other ventures. Some of the world's wealthiest individuals started as traders but became investors. using their capital to acquire assets that generate passive income. That's how trading evolves from income to independence. One key to sustainable scaling is emotional neutrality. As your position sizes grow, so does the pressure. A 1% move in the market might mean a few dollars at first, but thousands later, emotional control becomes more important than ever. If you find yourself nervous, reduce size until you regain comfort. Remember, you're not trying to impress anyone. You're trying to stay in control. Emotional composure is a sign you're ready to handle more capital. To scale properly, you'll also need a structured withdrawal plan. It's tempting to reinvest every dollar you earn, but the goal of trading isn't just to grow your account. It's to fund your life. Set clear profit withdrawal rules. For example, every time your account grows by 20%, withdraw 10% to your savings or investments. This way, you're continuously securing real-world gains while keeping your trading capital healthy. It's a way of paying yourself, the ultimate reward for discipline. Let's consider an example. Sarah, a trader from California, started trading with $3,000. Her goal wasn't to get rich overnight, but to master consistency. Over 2 years, she grew her account to $20,000 through disciplined 1% risk trades. Once her results stabilized, she began scaling, increasing her risk slightly, and trading higher quality setups. She also started allocating part of her profits into index funds and dividend stocks. Today, her trading income covers her expenses and her investments generate passive returns. Her journey wasn't glamorous. It was gradual, structured, and sustainable. That's real financial freedom. The next step in scaling is building multiple income streams around your trading knowledge. You might develop educational content, trading tools, or mentorship programs, or perhaps you'll automate part of your system using algorithms. The beauty of trading is that it can evolve into an ecosystem, one where your skills, insights, and creativity generate ongoing value. In today's digital world, even creating trading-related YouTube channels or newsletters can build wealth and community simultaneously. Finally, let's talk about freedom. The real reason we trade. It's not just about the numbers on a screen. It's about the ability to wake up without financial fear, to choose your schedule, and to live life on your terms. True freedom isn't working less, it's working with purpose. Trading gives you control over your money, your mindset, and your time, but it demands respect. The markets reward patience, discipline, and emotional maturity. As you stand here, at the end of this audiobook, think about how far you've come. You now understand the building blocks of trading: psychology, risk, strategy, and consistency. You've learned how to grow your capital responsibly and how to turn your craft into a sustainable business. But most importantly, you've learned that the journey never truly ends. Every day the market opens is a new lesson, another opportunity to improve, adapt, and evolve. And if you've made it this far, you're not just a beginner anymore. You're becoming what every trader aspires to be, not just profitable, but professional. Now, before you close this chapter, ask yourself one question. What will you do with this skill? Will you trade for short-term profit, or will you build long-term wealth? The next step is yours to take. And speaking of steps, if this audiobook ignited your curiosity about how emotions, behavior, and mindset shape financial success, then you must listen to The Psychology of Money. It dives into the emotional side of wealth, the very foundation that determines whether your success lasts or fades. Because understanding markets is one thing, But understanding yourself is what makes you unstoppable. Now you know how to start trading, but what if I tell you, having the knowledge of only trading will not guarantee success? Trading involves understanding the basics of the stock market to support your trading decisions. To get a complete understanding of the stock market and leverage this knowledge for your trading journey, click on the video popping up on the screen.